Oh, that music gets me fired up each and every time. Welcome out to our halftime report here, Coach T, Coach Matt, and we've got a guest here today, Coach Keith King, up from. Are you in Boston today or Providence, Keith? Where's your office at?
My main office is in Providence. I'm only up in Boston when I'm visiting with hedge funds.
Great to have you, my friend. All right, let's jump right into it. Matt, post-election day here. Obviously, you had quite a bit of news going on nationally yesterday with the elections, and the predictions you had in the Forex report a few weeks ago, Matt, were actually dead on last weekend, so kudos to that. Pretty interesting. What's your take on the first response from the market post-election?
Number one, I've felt for the last few weeks that what was what happened in the election last night was what the market was expecting, for the Republicans to control the Senate, to retain control of the Senate, for Democrats to win control of the House. It was fascinating to watch, and I was glued to the television between Fox News and CNN. That's kind of how I switched back and forth during the election cycle. But it was fascinating to watch that election last night, to see the outcomes in all of the tight races and whatnot. But from a pure market response, I think this is par for the course. And like I said yesterday, Tim, if you get that outcome which the market expects, you've removed the uncertainty from the situation. We know what we're faced with in the next 2 years. We know it's going to be gridlock in Washington. We know there's a couple different initiatives that they could work on together from a bipartisan perspective. But what we also know, Tim, is that the most likely scenario is the tax cuts that were put in place by the Republican Congress last year, signed by President Trump last year, the deregulation that we've seen over the last couple of years. That's all going to stay in place. And so with that staying in place and with gridlock being exposed, the only areas that you could really kind of expect any real true movement from a political perspective is probably infrastructure, maybe on trade, and Trump can still work those angles. But you could see some work together from an infrastructure perspective. But since the uncertainty is removed, I go back to what I said yesterday. If you look at the fundamentals of the economy and the fundamentals of stocks right now, you're still looking at a pretty significant buying opportunity, and I fully expect that to happen now.
The two biggest sectors that are moving today in terms of upward performance is healthcare and tech. And I want to bring Coach Keith in here, Matt. We'll come back to the S&P for a minute, but give me healthcare XLV, if you would. Healthcare is having a huge day, and we are rallying. It is showing a ton of strength. It's breaking out. It's even pressing up into resistance. Keith, what about the healthcare sector is so positive from a reaction standpoint to the midterms?
I think it goes back to the fact that the Senate was held by Republicans. Even they gained their lead. It was a 51-49, and it's either 53 or 54 seats they now have. So I think that's construed as a big positive for healthcare firms. I'm not sure if the Senate will get the approval they're looking for, but there's been talk about cutting back on pre-existing conditions, et cetera. That would be a bonanza for healthcare firms. So I just think that, generally speaking, the healthcare sector is going to benefit from any perception that the Democrats do not control both heads of the legislature. And indeed, they only picked up the House, which I think is less important than the Senate. But as far as what you had said earlier, Matt, I researched in the past, and it was always impressive to me that the market seemed to like it when Congress is a bit on the deadlock side. The old times when I came into business said, look at it this way, kid. If the Congress is deadlocked, they can just fight amongst themselves and they can let us do our own thing. The markets can do what they should be doing all along. The markets can respond to market events. They don't have to pay attention to political events. I don't think it's that way. I think there's too much media now in there that are going to get in the way. But back in the old days, the markets just loved when the Congress was deadlocked, and they just step around them and, like I said, tend to have some good bullish moves.
Well, quite frankly, I mean, as a business guy, as a capitalist, as an entrepreneur, as a trader, I like it when there's a mixed Congress. I like it that we focus just on the economy. I like it that we can focus just on fundamentals and technicals and all that jazz, because when you have one side control the vast majority of everything, you have a tendency to go to radical levels, both on the right side and on the left side. So for me, I personally like the fact that the uncertainty was removed. I like the fact that we know what we're going to be working with for the next 2 years. We know there's going to be gridlock amongst many different situations, but if we can just focus on a couple things, number one, the economy has been doing really, really, really well. That's number one. Number two, the fundamentals and the earnings of the last two quarters have been really, really well as well. Now that uncertainty is removed from the equation, I fully expect us to hit those highs again.
Matt, that chart is incredibly bullish. Obviously, you were in a lower low, lower high pivoting relationship, and then boom, you break out, you rally. A lot of this could be short covering. It could just be that sigh of relief as well. That hey, here we go. We're looking at the back end rally, and this is where multiple timeframes come in. Because if you were just on the daily chart, you would have seen the bearishness. But on the weekly chart, Matt, it was incredibly still strong. And we talked about this last week when we were going through this with our coaches, actually over preparing for our reports on the weekend. That's a beautiful candle setting up for more upside, in my opinion.
Especially in healthcare, but in the broader market, we still have some resistance levels we have to concern ourselves with. Yep. And I think some of those resistance levels are, happening very, very, closely. In fact, happening right now. We're back up into this 2,800 level. And then as you can see back here, old resistance back in June, old resistance back in March. And if you missed out on a lot of this snapback rally that was seen over the course of the last 2 weeks, look at a potential breakout of 2,800. That could be a strong intraday signal. I know we're range up on the day, but this is one of those days. You asked me, when we were talking this morning, Tim, does this market feel like it's going to be positive 1% today or positive 3% today? And at the time we were looking at the NASDAQ being up about 2%, Tim. Mm-hmm. And both of us felt like it wanted to hit 7,200 and then make a decision at that. And that's what I'm seeing right now in both the ES on the futures contract, testing that 2,800 resistance level. If you look at it from a 15-minute chart here, you really don't see anything over there because 2,800 was a few weeks ago. But if you look at it on the daily chart, 2,800 was very important historically. It's a significant hold number. So that's a level I would be looking at from a buyer's perspective, is that 2,800 level. The second level is right in this 2,820 to 2,830 level. And then you obviously have the decreasing 50-day moving average. So the S&P still has some significant resistance in front of it. But if you're a buyer, if you're a bull, and if you believe in that Santa Claus rally coming out of the election cycle, like we talked about yesterday, you got to absolutely love the price action you're seeing today.
Yeah, obviously. I mean, the market is rallying, and you're right. It does have this upward drift feel to it. And sometimes those psychological levels start to just become reality. It's what every trader starts focusing on. 2,800 on the S&P. We're only a few points away from it now, Matt. And we are hitting into that location. Keith, could you see a break and run this week from these levels? Or do you think maybe some of this upward action has to pause and take a relief here?
I just think that on the daily charts, they've run up, more than a week. So they may be paused for a little bit of retracing, but there's a whole lot of reasons why I'm very bullish here. I thought that the sell-offs were just a little bit too keyed in on the threat by the tariffs and the trade wars. And President Trump says he's working with the Chinese behind the scenes to get something done. In this case, I hope it was not one of his fibs. I hope that is done. If we can just get that behind us, I think that's the biggest reason why the markets pull back. As far as this week's go, I'm looking at charts here on weekly candles in the S&P and the NASDAQ. It take quite a run up for me to say that the market is officially broken back up into an uptrend on weekly candles. That's probably going to happen sometime next week. But I've been bullish on the market for a while because, we've had a long-term bull market. People always say, well, what do you think is going to cause the next market to sell off? Well, the conditions aren't there right now. If the Federal Reserve sees inflation picking up and they have to do something, and I'm not just talking about raising interest rates a couple more times at 0.25%. What if the Fed sees a lot of inflation kicking in? We're seeing it in wages, not yet seeing it too much in prices. CPI, PPI have been tame. If that starts to pick up, then I think the Fed has to go to the banks and start pulling back some of that money. That is where the key source of funds has been ever since quantitative easing started, and the money's still in the banks. There is still plenty of cash in reserve to continue driving the market higher. And they always said to me as a trader on the floor years ago, don't fight the Fed. So unless the Fed changes its still dovish monetary policy, interest rates at 2% aren't going to impact the market. If they had to start raising rates 1% at a time, well, then money flows into fixed income. But right now, it's really the best of both worlds for the equity markets, and I continue bullish, but I will only change my tune if one of two things happen. One would be the Fed is taking money out of the banks, and two would be if the trade war gets serious enough that it's impacting U.S. businesses that either can't get the parts they need or can't access the markets that they already have, and I don't think it's going to get to that point.
Yeah, well, we do have a Fed meeting tomorrow, Matt. We don't expect a big, announcement or anything out of the ordinary from the Fed tomorrow. We will break that down when they do release that policy statement tomorrow. But I'm with you. I mean, the Fed could throw a wrench in it. And we were just a few weeks ago, and I think it's important to remind everybody, just a few weeks ago, we were talking about a bear market. We're talking about lower lows, lower highs, putting in pivot points and a lot of pressure. So I think you have to respect the fact that we have 6 out of 7 green candles. You have strong weekly opportunities, and you could even break out and run here. There's no doubt about it. And we talked about this yesterday, and you even broke down all the seasonal reasons why the market might be moving bullish here, Matt. But there is still risk on that downside, in my opinion. There's too much congestion that we still have to get through that we've not done that yet.
Well, like I said, there's still many overhead resistance levels that it has to clear out, right? You got to clear out of 2,800. You got to clear out of 2,825, 2,830. You got to clear out of that 50-day moving average, and then ultimately 2,850 to 2,870 before you can really kind of start talking about this being a bullish trend. But you can't deny the fact that there's strength coming into this movement. Number one, you've had, 2 straight weeks of bullish behavior after you got overextended a week and a half ago. You've had, volume's a little bit of a concern here, but a couple things that I want to point out. Number one, Tim, if you do break out of that 2,800 or that 2,825 level, the RSI on this index right now is only at 53. And I know we've had a radical shift in price movement over the course of the last 2 weeks, going from 2,600 all the way up to 2,800. That's a big time movement on an index, Tim. That's like 7, 8, 9% movement on the index, but you're still not overextended based on your indicators. Your indicators still signal that you have potential room to go here. And again, you got to take that as a positive from a bullish perspective. It's not going to snap right back to the all-time highs. It's going to be choppy. There's no doubt about that. I mean, like I said, on Monday, once we get past the elections, we're going to be looking at the Fed on Thursday. So, it's gonna have some resistance levels, but the overall mindset of the market right now is a buyer's mindset.
One stock that is down 2.5% today is General Electric. Just want to point that out. That
Hey, Quora, no.
Well, it's funny though. I did see a question on Quora the other day, Matt, is why do traders sell, or why does anybody ever sell a stock for a loss? Wouldn't you just hold it until it comes back?
Yeah, hold it until it goes to zero. That's what
hold it until it goes to zero. That poor company.
Just whenever you answer Quora question, you should literally just say, you guys should not trade.
Pretty much. One big mover obviously is technology, Matt. I'm looking at some really, really strong moves in some of the biggest names out there. Amazon 5.3% up, Netflix 4.5% up, Google 2.5%. You're seeing strength across the board. Apple 2%. The NASDAQ here, obviously, it was beaten up the most, so it has the most potential for a rally, a snapback rally. Well, that's true. Yeah. What's your read here?
Again, very similar to the S&P 500 here. You got to love the snapback rally that's happening in across the board in tech stocks. You have this is an index up 2% today. I fully expect it to continue to be bullish. The mindset is bullish. It's up above the 200-day moving average. The key levels I would focus on here in the NASDAQ is 7,200. Now that you're back up above those support levels at 7,000, as well as the 200-day moving average. So those are going to act as support now. So the 200-day moving average is going to act as support. The 7,000 mark will act as support. But overhead resistance, you got to look at this 7,200 level. You break above 7,200, you're a stone throw from 7,350, Tim. That's another 150-point range you can get back up there.
Yeah. I mean, this is the developing pattern of an inverted head and shoulders, and you're going to get a lot of different back and forth in trading ranges over the next month or two, Matt, as these patterns develop. But you got to like the upside, and obviously the strong candles. We're at 2.1% here today, about an ATR up. It's an incredible market we're in where 1% is not that big a deal. I mean, the market can move 1% in like 15 minutes these days.
1% is nothing in this market right now.
Keith, would you buy tech here? I mean, are you looking at long tech opportunities?
Absolutely, guys. That old saying, you can't keep the good ones down. I was trading on the floor back in the 90s, and I learned back then that I wanted to invest in technology. It's evolved, because investing in technology back then, it was software and hardware companies. Now it's a whole lot of different things. It's media companies, it's biotech companies, but you do want to be investing longer term in tech. If you're talking about longer term, I'll always invest in technology. And if it's the right time right now, I still think it's a good time because of the trend upward. Don't be surprised if we get a retracement. That's what we were all talking about. It's going to be hitting levels of resistance and turning down. But I'm bullish on the market unless the Fed changes policies. And just looking at the Fed fund futures rate, nobody thinks there's going to be a rate hike today. Excuse me, tomorrow. Slaves to the Wednesday announcements. And there's not even a total consensus that there'll be a rate hike in December, but there is a majority opinion. So I don't think the Fed right now is planning to do much to disrupt this amazing bull market. You have the cyclicalities going for you, et cetera. So to get back to that, Tim, I've really enjoyed investing in technology since the 1990s. And probably that's about the only good thing about being an old guy. I've been around long enough to enjoy some of these great runs and build the 401ks. And that's what the tackle trading folks should be doing, is building their wealth over time. There's always day trades, there's swing trades, but it's going to be, there won't be a lot of times in my whole life that I will be really bearish on tech. It tends to be for shorter periods of time.
Top 5 stocks gaining on the NASDAQ 100 today: Align, Workday, Amazon, American Airlines, and Adobe. WDC, Matt, give me one chart here on WDC. Actually, a bearish stock. If you're looking for bearish opportunities, there still are some retracements. So if you're out there and you're thinking, okay, the bull rally looks great, I've got all these different bullish ideas, but maybe I also want to have something bearish, there are some setting up here in bear retracements, Matt, that have come up off the lows, just like WDC here. Interesting action in tech, obviously, here today. Give me the Dow Jones, Matt, if you would.
And very quickly on what you just said, Tim. There's still a lot of good bearish retracements out there in the market. Just because the market's doing really, really well today doesn't mean we're just going to go buy call options. You gotta approach the market with caution still. You still got to have, even with the snapback we're seeing over the course of the last 2 weeks, Tim, you still have a market that has pressure on resistance to the downside. So to me, you still got to be cautious in this marketplace, but the overall sentiment is bullish. But this WDC, we've been nailing this over and over and over again, and it's about ready to get nailed again.
It looks like a really, really good setup. Bear retracement, red candle. The market is so strong here today, but it's actually sitting on a red candle about to trigger, Matt, below yesterday's low. So there are a bunch of setups. I mean, there are trading opportunities on all sides right now. There's no question about that.
Well, I love what Keith said just a moment ago. From an investor perspective, you should always be investing in growing wealth for the long term, right? Mm-hmm. In a short-term perspective, yeah, I mean, traders will do anything in the short term, but the long term, the sentiment is still bullish right now. I would push back a little bit. I think the Fed's going to do a little bit more to drive that volatility than Keith does, but I could definitely say, but I definitely do agree with him on, if they do pull liquidity from the banks, that would be a sign that something bad is happening.
Mm-hmm. Let's look at the mega cap and blue chip stocks out of the Dow Jones, actually, Matt. Let's move on to that one. United Health actually doing very, very well today. We talked about UNH and healthcare in general, and you're seeing some of these names really rally. The Dow broke the pivot point, Matt. That's a breakout. I don't know where the target would be here. Maybe 26,000, 26.5. We're at 26 right now. When we were talking earlier today, we said it's going to go there today, and it already has reached there. Long blue chips looks like a good play here, Matt. What's your read on the Dow?
It's the best looking industry. It's the best looking index, no doubt. It has cleared those resistant channels, unlike what you're seeing in the S&P when and again, everything's kind of bullish today, but you're still below 2,800 on the S&P, and that ultimate, previous retracement we had at 2820 to 2830. So you still have those resistance channels to clear to really kind of get into more of a bullish sentiment. And then once you clear those, you still have a decreasing 50-day moving average that could, act as a little bit of resistance. You see a very similar sign on the NASDAQ where you have this 7,200, and then you have the 50-day moving average as well as the previous pivot up here at about 73.45, 73.50. Unlike those, when you're looking at the YM and you're looking at the blue chip Dow companies, you have cleared those levels, Tim. You've not only cleared the 200, the 20, the previous pivot that we talked about, that being a buying opportunity yesterday. You're now up above the 50-day moving average. Now, the market might sell off coming into the close just simply because people might be locking in profit, but you got to love this price movement on the Dow, no doubt.
Yeah, beautiful breakout. In fact, UNH, biggest performer on the Dow here today. Let's take a look at that stock. Obviously, we had that on the bullish list recently, breaking out of a major resistance here. Obviously, strength there. Microsoft up 4%, Pfizer up 3%, Caterpillar 2.7%, Merck 2.4%. Keith, blue chips in general tend to, foster a degree of safety. If you had to go either, the aggressive growth areas or the safer, more, stable, bigger companies, do you like blue chips or do you like the more aggressive growth?
Well, I hate to have to say that I like both, but I do actually like both because, number one, you want to make sure that your clients are trading in a safe manner, and blue chips tend to be safer. But like I said before, I'm just very happy about the gains that my IRAs have made over the years, investing in more of the risky tech companies. Heck, I did something you should never do, folks. I was buying some technology companies when I didn't quite really understand what their technology was. I knew enough about it. Maybe it was like a server company or a router company or whatever. But there's enough that I knew that they were growing. I could see the stocks were doing well, et cetera. For safety, you do want to have blue chips. But, we also want to have at least a portion of our portfolio in more aggressive markets. Healthcare is great right now. Technology is bouncing back.
Mm-hmm.
My Wednesday morning trading labs, we were looking at sectors. We do it every week. We only had 2 bullish sectors for a couple of weeks in a row, naturally with the markets going down. They were the 2 you would expect, consumer staples and utilities. But everything's turning quickly. Just did it this morning, and lo and behold, look at how good technology is looking. Look how good healthcare is turning back. And even the consumer discretionaries, XLYs, which, my goodness, consumer discretionaries, you look at monthly candles for the last 10 years, has just been an amazing ride, as has things like you just pointed out, UNH, and even a couple of my stalwarts, even MasterCard and Visa, which turned down so aggressively, starting to look pretty good to me again.
Yeah. Weekly candles are actually showing you a lot of strength here, Matt. And there's several areas that are, flashing buy signals still. And even on that Dow, tech, discretionaries, all of them, they're all looking pretty strong.
Well, I think the story of today and the price movement that we're seeing coming out of the midterm elections is healthcare number 1, technology number 2, and consumer discretionary number 3. Those sectors are flying today, and there's a reason for that. Discretionary is going to get discretionary, and technology will get Santa Claus rally coming into it, and obviously the market has loved the gridlock and the gridlock with the split Congress on healthcare.
Mm-hmm. Yeah. All right. Let's take a look at the Russell 2000 as well, Matt. You talked about the potential upside. We're already flying, looking at 1600 here, just within, shouting distance, about 25 points. At that point, you are going to be out of resistance. And a lot of these, markets are not necessarily out of the woods yet. You look at the small caps, you still have a 200-day moving average, a falling 50-day moving average. Now the 20 is rising. So you're in this little moving average soup here. Small caps still got some concern, but they've also come back up quite a bit off of those lows. Are we moving more into a neutral pattern here? Would you be bullish yet here? What's your read first, Matt, and then Keith?
Is it a soup or is it a stew? Which one would that be?
Either way,
just throw it to like our grandmother used to do back in the 80s, right? Just throw everything in there and just call it whatever you want. That's kind of what the Russell 2000 is doing here. Once it got back above 1550, which I saw as the resistance level, it was showing some strength to me. The 20's now crossing, and it's got a tremendous amount of room to catch up. Yes, it's been the one that got beat up the worst, but I've changed my tune on the Russell a little bit over the last few days, and I fully expected to hit 1600. And once it hits 1600, Tim, at that point you're no longer bearish. At that point you're in some type of neutrality, and you're looking for breakouts of 1600 and then the 200-day moving average.
Keith, I had an interesting conversation with Matt and Mark about a month ago, and Mark had mentioned that, rising interest rate environment, these smaller companies, they have to borrow money. Does the rising interest rates from the Fed affect your view of small caps, or are you going to just trade the chart? What's your read on the small caps?
My read is that I tend to be more of a chartist anyway, and I'm loving the charts right here. Just say though, I count candles because hedge funds have taught me years ago that there's only certain candle runs, 2 to 5 candles, 6 to 8, et cetera. And you can kind of base them on standard deviation moves in the markets. So I keep saying I'm expecting a retracement, but overall, I'm very bullish on the market. Small caps do have to borrow more. There's no question about that. But rates are still not anywhere near like, historical norms. So I don't think it's been cumbersome to them. It's not like some of the governments that can't even service their debt. Smaller companies, I think, are going to be fine for a while yet if the interest rates don't rise any much faster than they have been. They probably would not be directed to even be 3% a year out from now, and I don't think that's going to hurt the smaller companies. But, I remember, guys, I came from being a floor trader. I was just a chartist. I didn't really have to pay attention to too much because we tended to be day traders. If I had to carry a position overnight, if it was forced down my throat, then I did it, but that was only begrudgingly. So I think that the charts don't lie, and I do think that there are times when the fundamentals can surprise us. We see something we don't think is as strong fundamentals. Fundamentals are not implying to us that it's going to be going up all that much, and yet the charts are just saying, "Oh, buy the thing," and hold your nose and buy it if you're not sure. But going back to the clients on an overnight basis, you do have to be pretty sure you know more about the fundamentals. But no, the charts are looking just fine to me, guys.
Let's break down the dollar and the commodities, Matt. Obviously, the Fed meeting here, it started today. Because of the elections, they pushed it one day. Usually they have their announcement on Wednesdays. It actually doesn't come out until tomorrow, 2 p.m. Eastern. No expectation of a surprise, but you never know with these announcements. We've actually talked about this plenty, even on the halftime report. The last few times we've had announcements, they're not as volatile as they used to be. 10, 12 years ago when we started trading, it used to create a lot of movement in the market. Hasn't necessarily been that way for a while. The dollar is in a pullback here. And in fact, a little down candle here today. Do you see this as a buying opportunity? I know that, we were waiting to get through some of this news. So what's your read?
I'm not seeing this as a buying opportunity yet, and keyword is yet. And I don't think we should do anything before the Fed on Thursday. And I'd like to get Keith's take on it. But, my take on the Fed on Thursday is they're not going to do anything, and they never do anything in their November meeting, and they always wait for December. So I do personally anticipate a quarter point hike in December, but I don't think they're going to do anything in November. Could they change their language within the communication they send out? Maybe, but I doubt it. I think it's going to be par for the course on Thursday. And you're absolutely right, Tim. When we first started trading, the Fed was everything. The Fed, and they still are. But when we first started trading, we were coming out at the tail end of, and this kind of starts dating us here, Keith, the tail end of Alan Greenspan's reign at the Fed, and, Bernanke's beginning of the Fed, and especially with Bernanke, Tim, early on, he was taking radical actions with the Fed policy in 2008, 2009, and 2010. So, early on in our careers, we had a much more proactive Fed than what we had from 2012 till now, when Janet Yellen and now Jay Powell takes over. I've liked the transparency that Jay Powell has put out there this year. I hope he continues to be transparent, and so I don't expect them to do anything in November, and I expect them to have a quarter point hike in December.
Is there anything the Fed could say tomorrow, Keith, that would surprise you, that would throw you off guard? What are you watching for from this event?
Well, you were talking about, what is the Fed going to say? They've been very accommodative, and they have that language about remaining very accommodative. The interest rate hikes aren't bothering me, with, as I said before, way below historical norms. If anything changes in the language about them saying we plan on becoming less accommodative, that would be, I think, a hint that they're actually starting to think about taking some money back from the banks. The Fed's been retiring some of the debt, the debt that they took off the books of the banks, and that's been cutting back a little bit of the funds that they initially put into the banks. But I just think that their wording's been great. I think Powell's awesome for one reason. He didn't bite on the stuff that Trump was saying. They didn't get into any kind of a war of words. The Fed is supposed to be independent. I'm not a fan of the Fed, but I don't think they should be political in any way, shape, or form. Whoever has been appointed, whatever president appoints them, is supposed to do what's right for the money supply, for the economy, etc. And he didn't seem to be going to get involved in a war of words, so I like that. I don't expect the language to change much. There's always the two things. What's they are announcing as far as Fed fund rates? That's almost definitely not going to change now or in November. And secondly, what do they do about the wording of a Fed accommodative policy? And that hasn't changed too much. I don't expect that to change. I think it's just a relief that the elections are over. The market obviously got what it was hoping for. Basically, that idea of the mixed Congress, and let them kind of stay out of the way a little bit. So I think the conditions are right for a nice rally, not necessarily in the dollar. The dollar is retracing and it's far overdue. It came up to a big resistance level of about 97.5 and turned back down.
Yeah. Let's take a look at the commodity market, Matt, here. Crude oil first.
Can I say one thing
to
that?
Yep.
Jay Powell is a straight up gangster, and he's not going to care one iota about anything that Donald Trump says on Twitter. So
he hasn't seemed to care yet. Yeah. I mean, Powell's not going to be moved around by Trump. I don't think so.
No.
He has not shown that he has.
He has shown no inclination.
Yeah.
No inclination that he's going to get into a war of words with anybody.
Sure. Yeah. Let's take a look at crude oil. Obviously, the EIA numbers here today, and crude oil has been bearish. We were having a conversation just as a team yesterday, and one of the coaches said, "Hey, would you play oil here to the long side?" And I'm like, "Not yet. No, not a chance." Crude has been bearish. It's still showing a lot of weakness. I know that it's down 8-9 days in a row, and you are in oversold conditions. I'm sure that a lot of technical indicators are going to tell you that you got to rally back up. You have a relief rally coming. Maybe, Matt, but we're not seeing much strength here in crude oil yet. Obviously, a little doji candle here. What's your read?
Well, I think Keith said it best in the pre-production today when he said, you know what? Crude did what crude does on the EIA. It went up in front, got spanked on the downside. coming out of it. Crude's extremely bearish. It's overextended to the downside, no doubt. But Tim, this is a commodity that in the last month has went from 76 down to 62. It's lost 14 points off a $76 index. 14 divided by 76, it's dropped 18.4% in a month. You can't deny the bearish mentality here in crude. Now, with that said, I do anticipate a technical rally, maybe a little bit of short covering here, but a technical rally, a little bit coming back into that 64 channel, but that would be a bearish opportunity. So no, to me, it's extremely bearish, and it's not coming into a season like natural gas in December where it has some degree of positive seasonality. Crude doesn't have positive seasonality until most likely February or March of next year.
U.S. output today in that report did hit a record high. So they're putting a lot of oil out there on the market. We had sanctions on Iran recently. Keith, crude has been just taking it right on the nose for about a month here. What's your read on crude oil?
Well, it's interesting. What I do a lot is I talk to my friends from trading floor who have moved on into hedge funds. And this is one of the 2 times that I think hedge funds totally misread oil. They were also convinced, and they knew the sanctions were coming back in Iran, and they thought that was going to disrupt Mideast oil more than it ever did. And hedge funds are really big buyers of oil back pretty much close to the top. And if you want oil to go down, watch hedge funds when they get caught long contracts and they're worried about getting out of them before expiration, because nobody really wants to see out contracts, obviously, except the refiners. What are they going to do with the actual physical crude oil? So I was kind of seeing some selling in crude oil that reminded me of what was happening after or during the crash of 2008. Hedge funds were loading up on oil throughout 2007, and there was enough demand that they could just dump the contracts in the last couple of days before expiration. Mm-hmm. That's not the case anymore. There's more on the market. There have been no major disruptions out of the Mideast. So the supply's been there. We're doing great as a producer, and the hedge funds got sandbagged on this particular one. Obviously, a technical bounce is anticipated, but we're just coming in a series where there's just a lot of supply. And I don't see any more disruptions. Venezuela's already been factored into it. So I just think there's plenty of supply. We might see, as Matt was saying, seasonality if we have a really cold winter up here in the Northeast and they use a lot of this stuff. But otherwise, it doesn't look very good for oil going forward. And as I said, the hedge funds, they're no longer loading up on oil. And they were the big drivers of the market there for a while.
Mm-hmm. Technical bounce could be in play here, obviously, like you guys are talking about. That's interesting about the hedge funds. It makes me want to talk about natural gas with Keith here and get his take on that gap the other day, Matt, because Keith, obviously this is not expected with futures contracts to gap over the weekend. NG on Monday jumped out like 7-8% and just took off like a juggernaut. I've been bullish on this contract for a while. I like it. Do you see that very often with gapping in futures?
Very rarely. It tends to happen more it only happens over weekends, let's face it, because they're almost trading continuously 23 hours a day. They shut down 5 to 6 p.m. Eastern time when there's not much going on in the markets. I've seen it happen when there's been geopolitical events over a weekend. It could be a terrorist event. It could have been an unexpected result in the European election or whatever it might be. No, that one shocks me. And I was on the phone and the hedge funds were shocked by that. I'm calling my traders that I have from friends from hedge funds and institutional trading desks. Nobody can figure out why there was such a powerful movement. It has been in a nice trend, and I think it's overdue for a really big move to the upside. It's just been so undervalued. If you look at the value of the BTU of energy, natural gas versus crude oil, it should be much higher. But no, you do not see a lot of gaps.
You're in Boston, right?
On weekends. Yes, I live in Massachusetts. Yep.
Yeah, you're in Mass. So was it really cold this past weekend up there?
The weekend actually moderated. We had an unusually cold month of October.
Because that was, and the reason I ask is because there was a headline out there coming out of the weekend. Because I was trying to find the reason why natural gas had such a massive move to the upside over the weekend, and there was one report that said, "Well, the Northeast was cold," and so I was just like, "All right, whatever, okay."
There's 2 types of cold. It was a cold October, but it wasn't like what we get in November, December.
Yeah, I still don't understand exactly why we saw such a strong gap coming out of the weekend.
I couldn't find any pipeline shutdowns. Was you guys find any?
No, I didn't. The only thing I found that was really, really, and again, I'm not saying this is evidence here, but it was just, it's cold in the Northeast. You do have some seasonality coming into the end of December, historically speaking, of a bullish movement here. But for the reality of the situation is a gap like this you're not buying it at the overextended ranges. You just can't. Okay, you gapped right into a very powerful resistance level of 3.6. It's slowing down. I think we got to give it a couple of days, maybe even a week or two, to really kind of see natural gas settle down.
Mm-hmm. Yeah, you can't go long up here. I was talking to a trader the other
I was thinking
day.
about selling a call option, Tim.
Yeah, you can short up here.
Yes.
Yeah, you could short a call like up at the 5 strike, 5.5 strike. There was actually value that deep out of the money. I think Gino called this the widowmaker, though, because
He did.
natural gas has those parabolic moves where it can actually just run and whipsaw you out. If you are short options, low delta, Matt, this is one of those type of products.
I've traded natural gas a lot on the naked put, naked call, short strangle type trades, and I'll tell you right now, it's not for the faint of heart. You might sell a 3 to 5 delta, and you might have 95 to 97% probability, but it will test you.
Yeah. Yeah. As I'm looking through the commodity market, one area that I do want to talk about is gold as well. Gold is actually up 1/3% here today. Try to find some support, rotating up. Still has not broken out yet, Matt. I know that I like it. I'm actually long here. You've been bullish on gold as well. But if a trader's looking for confirmation, it probably has to clear 1240, right?
Yeah, it's got to close above 1240.
Yeah. Keith, what's your read on gold?
We discussed that a couple weeks back. I like the way it built a base. I expect it to break out to the upside, but I don't think it's going to happen until maybe next week or sometime after that. There's a lot of overhead resistance, but it's overdue for this. It's been so undervalued with the dollar at least weakening a little bit. It's giving gold a chance to maybe.
Hey, Keith, I want to get your take on something. There's a report that came out recently that an ex-trader from, I want to say JP Morgan, is basically discussing how for the last 7 years, they have been manipulating the value of gold at the institutional level.
Right.
Can you speak to that?
Well, I hear a lot of that because one of my 2 older brothers is an absolute gold and silver fanatic. I trade gold, silver, oil, S&P, NASDAQ futures. One brother only trades energy futures. The other one only trades gold and silver futures. And he has been giving me all kinds of articles over the year saying that has been held back by institutional traders, and that they even think like the exchanges to some extent are in on it, that they don't have enough gold or silver in stores at the exchanges if everybody started looking for physical delivery, and that the institutions are purposely keeping the prices down, so that never really happens. I don't know. That's, it's like trying to say you hear the shadowy ideas behind central bank decisions and everything else. But I've been hearing those reports for some time. I should have brought got my brother into this call. I happen to know that he's out of the golf course because I said our temperatures have moderated quite a bit here. But he's been showing me articles on that since back on our trading floor days. And he's even a bigger believer than I am in accumulating gold and silver over time.
Mm-hmm.
Yeah, I do believe, and I know it's a little conspiracy, but I do believe that the Chicago Mercantile Exchange, JP Morgan, and other institutions have been manipulating the value of gold through margin hikes and other areas of the market. But at the end of the day, that's going to be fascinating to watch that play out. Doesn't matter. It's still close to the break of 1240.
I agree.
Yeah, you guys ever see what happens to silver when it gets a little bit too high for the government's comfort level?
Yeah, it gets smoked back down.
They did you see what they did back in, what was that month when it got up way too high up there? It was approaching 50.
It was August of 11.
Yeah, and they just totally upped the margin by a factor. I think it was like 1,000% overnight, something absolutely crazy.
Well, and that's kind of my point, Keith, is that over the course of the last few years, and there's historical evidence here as well, back in the early 1980s when they were radically increasing the value of future margin. So as you can see, this great silver run that was happening coming out of the crisis in 2008, 2009, you just saw it go parabolic, Tim. This was on an Elon Musk rocket ship. And then right into these levels in 2011, you started dramatically increasing margin requirements at the Chicago Mercantile Exchange. And that just forced a lot of the small time traders, a lot of the speculators out of the market. That drove supply down. And so I do believe there's some of that happening, but at the end of the day, you got to trade you can't bitch and moan at Wall Street and cry foul over the things that they do. You got to focus on the chart and focus on the tradable signals and apply your trading plan.
I agree with all those things 100%. The reality is I like silver physical, by the way, because then I'm going to hold on to it. I like gold above 1240 as well. But
Mhm.
silver breaking out at 15 would also be another nice signal and a trigger. Here's the thing I got with all that conversation. Doesn't Wall Street manipulate every product, though? I mean, I know they manipulate silver and gold, but isn't that the whole point of Wall Street is to manipulate prices up and down to
Well, that's
trade?
one of the reasons why I said you shouldn't buy Bitcoin in December of last year when it was introduced into the futures market. But in the futures market, because of the way the margins are handled in the futures market, Wall Street, the Chicago Merc, Chicago Board of Options Exchange, they have more flexibility to price manipulation because of margin requirements than they do in the stock market.
Yeah, I agree. Bunch of stocks have earnings that I actually want to take a look at. One of them is Roku, Matt, ROKU, going to be coming up. I also want to take a look at Take Two Interactive, I believe. Roku earnings tonight, I believe, after the bell. And we've got some volatility on the board for the next few days. After we get outside of this week, by the way, we are going to be past most of earnings season. This company is one of Cody's favorites. Is actually looking like it wants to rally here. It's up 5%. What's the MMM on this one, Matt?
Whatever it is, it's going to be big.
It's going to be a huge move.
Yeah. 8.2 against so 8.2 divided by 58. It's got an expected price move of 14%. T.
So in this market where you're getting all kinds of crazy radical movement, you got earnings after the market close, you'd have to do something bi-directional. You wouldn't sell short strangle here.
No, you wouldn't sell a short strangle, but you do have evidence that it does move quite a bit on earnings, Tim. It went from 47 up to the gap of 53, so a 6-point movement, and then it ran after that. So if you're looking at 3 of the last 4 earnings seasons, this one right here, don't even need to look at the numbers here. It's easy to look just from a price perspective. You look at the one over here, the one here, and then the one here. Short strangles would have been blown out of the water there. It would have been, they would have been absolutely crushed there. So if you see this type of evidence where the market expects volatility, we expect volatility, the only thing you can really kind of do is price in perhaps maybe a debicon or something along the inverted fly. But outside of that, no, you got no short strangle here.
Yeah, you've got some other bigger names actually that are going to be reporting. Qualcomm is one of them, a tech company after the bell. You got Prudential, Keurig, Manulife, and Square. Square is one of the more popular stocks in the marketplace that has earnings coming up after the bell. Volatility in a lot of these names, Matt. These are not for the faint of heart. And if you are trading, just a quick reminder to always double check the earnings data on all of these kind of things. Square, it was one of the highest flyers in the marketplace for quite some time. During the correction, it came back about 30 points. That drop from grace from $100 all the way down to 65, 35% correction. Now we're breaking back out. Earnings are going to, kind of throw a wrench into all of it.
I wish earnings was not today, because this is the pattern we've been talking about, the breaking of the previous level of resistance that happened in this initial movement in October. That's a beautiful breakout right there. But alas, you can't just deny that earnings is tonight. Earnings on Square, you got a market maker move. The expected market maker move is 6.7. And you can look at that on the market maker mover. You can do it, based on average gap ranges or whatnot. But 6.7 divided by the current market price of 82, that gives you an expected market maker move of 8.1%, Tim. The evidence on this company with recent earnings, Tim, is you had a very small movement here. You had a very small movement here. You had a very small movement here. And then you had from open to close, you had from open to close, you had a small movement, then it kind of ran after the market opened. But Tim, the evidence does suggest more of a, multiple month type short strangle situation here. I wouldn't do it personally because I'm not, given what's happening with the entire volatility of the market, but the evidence does suggest a short strangle. I just don't think it's a good trade.
Another important stock for my watch list, one that I've been trading and tracking for quite some time, is Wynn Casinos. They have earnings after the bell as well. And WYNN, the casino and international kind of resort type companies, gaming companies in general, they've been destroyed this year. They've been in beautiful bearish downtrends. I'm not going to trade the earnings here, but I will be watching this one for tomorrow. There's no question about it. A lot of of volatility. Keith, I want to get
break under 100 on win, break above 120 on win are the two signals you're looking at.
For sure. Keith, do you trade any earning strategies? Is that a part of how you approach the markets, or do you usually wait and just react to the post earnings?
Well, first thing I want to say up front is one of my focus stocks is Las Vegas Sands. When I first left the trading floor, I just had a couple of really tremendous trades, and I've kept that stock ever since. And just like Win, it's been in just a massive downtrend. It's been on the focus list as a short play for months and months, and it just basically stopped out about a week ago. As far as earnings play, they're very dangerous, you guys know. I got to think about where I came from, being from the trading floor. One of the most favorite strategies by a hedge fund is short straddles. If you literally sell calls and puts right at or near earnings date, we all know how high the volatility is. We know how difficult it is to make money on a long straddle if you buy the options too late, too close to earnings. So I played around with some of those in the past, short straddles. But the stocks we were discussing prior to when you were talking about Square, well, Square is just like Visa, is just like MasterCard. And I think we talked last Friday night about how Visa was looking for a nice breakout. That's already happening. But as far as earnings play go, if I was going to do anything, I would do a short strangle, but I have to really be confident in what I know the company's movements tend to be. A lot of upside risk in those trades. But as I said, hedge funds do it all the time because they know what we know. They know that options get implied volatility gets way too high right before earnings. Buying them is out of the question. So they go the short straddle route.
Market kind of settling into a very tight range here on the intraday, Matt, and really doesn't know where it wants to go. I think the natural thing we would assume a pullback, but I don't think you can assume anything like that with the strength we're seeing today. Across the board, very green. The heat map is just bright green, and we're seeing a lot of strength. Unless you see weakness, obviously, there's still quite a bit of opportunity here. LVS, now, it's an interesting one on this one because when you got a Win casino, LVS is going to move on Win's results. There's no doubt about that.
The reason I kept Las Vegas here, I just want to point out something. Post earnings, they had a negative reaction, but if you're looking at this from a pure charting perspective, guys, this trend has been very consistent to the downside. Very consistent to the downside. This is something we have been just hitting over and over and over again. And if you look at that trend to the downside, guys, and like Keith, you said, it got stopped out last week because it got back above that trend line. And that's because you're starting to see a little bit of a head and shoulder reversal pattern here, Tim. Left shoulder, potential right shoulder, which means if you're looking at a potential, let me pick up something off the bottom and I like this company type situation, a breakout of 58 down here would be strong.
I agree with that. Yeah. One big name that does have earnings tomorrow after the bell that we'll break down tomorrow is going to be Disney, and then Activision as well, the gaming company. But Disney, a very important company for the market with earnings kind of flat here in anticipation of that. Even though the Dow's doing a lot, Disney's actually not really doing much. Activision will have earnings as well. And really, after we get through this week, Matt, there's not that many companies that are trickling in for third quarter earnings. Almost everybody has reported. And so we can just get down to trading the technicals and off the Fed meeting and all the other stuff that goes on in the economy. But earnings season is pretty much in the rearview mirror.
Oh, yeah. And that's kind of what we were talking about yesterday, Tim. Now that we're coming, being removed from the midterm elections, now that we're kind of seeing, third quarter earnings kind of come and go. We've had a good earnings season. The market responded favorably to the election from last night. We know what we're going to be working with from a political and perspective in the future. We know what the Fed has been doing. They've been transparent with us. We know they're going to normalize interest rates to a neutral stance. They're not going to be accommodating, and they're not going to be try to limit and restrict economic growth. This market's going to rest on its own economic laurels, and that's what I like. That I like the fact that we're coming through a lot of transparency and we're coming out of a lot of the uncertainty.
Yep, I agree with that. Quite a few stocks set up. One that I'm watching, Matt, for a potential trade here is Facebook, actually. With all the strength in technology and the NASDAQ, Facebook's not really doing much, sitting at 150.27. I like the weakness here for a potential reverse counter trend trade. And obviously, with the trend on Facebook, but counter the market. Market pulls back, that breaks below 150. I like an entry there.
I don't mind an entry under 150. That's aggressive. A little bit more conservative would be 147.5, which is kind of the low of the base there. So if you put this on an hour chart, you can kind of see that low right there at 147. So I certainly understand the break under 150, looking at another potential trigger underneath 147.40. that would be more conservative. But the strength of the market, guys, yes, but okay, we love what happened in the market if you're a buyer, if you're a bull, and all of that jazz. But there are still tremendous bearish opportunities, and this market still has overhead resistance to contend with. Outside of the Dow, it still has overhead resistance to contend with. One day does not make a trend.
No.
Okay? One day does not make a trend. We need to see follow through, breaking out of those resistance channels. We need to see it retrace back down into support, setting a higher support level than what it established in its recent bearish downtrend. That's what makes a trend. Trends take pivots. Pivots take time. You need at least 3 to 5 days to create a pivot. You need multiple pivots to create a trend, which means at a minimum, Tim, you need another week, week and a half, 2 weeks to even determine if this is a bullish uptrend. So let's not be too premature in saying that, there's nothing to see here. Everybody go buy everything, because it still has a lot of resistance. There's still a lot of bearish downtrends, and the market still has to contend with the overall negativity that came out of October. There's positive momentum for the bulls. Let's see that follow through, though.
Yeah, I obviously keep a bull list, a bear list, a neutral list, and really there's a lot of great day trading opportunities in a market like this. Keith, as you know, on a Wednesday, we always bring a guest on. Thanks for being here, by the way. Obviously a long-term coach with us. We've known you for a very long time. Keith, you like to day trade the market, and obviously when the volatility is high, like it's been in October and November, day trading creates a bunch of opportunities. Well, let's talk about that for just a minute, if we could, Keith. And you're on mute, by the way, my friend. I'm off mute there for a second. There you are.
No problem.
Keith, in this market volatility, what advice would you give new traders out there? And then also the day trading aspect. How do you like to day trade in this market?
Well, the markets are just an absolute heaven for day traders. The volatility, of course, has spiked up dramatically. Let me go back to my daily candles on the S&P and the NASDAQ. We had situations where, the NASDAQ's missing. I'll bring it up. We were sitting on the NASDAQ market, bringing up the ATR now, where we had a baseline of maybe about a 80, 90 point move a day in the NASDAQ. Well, it's up over 200 points right now. So obviously the volatility is easily doubled. Now, what that means is that you're going to have tremendous day trading opportunities. And if you really want to ever get into day trading futures, I would recommend doing quote unquote day trades in the evening. By day trades, I just mean get in and out in the same geographical time frame, because in the evening markets move a lot more slowly. But when I'm looking at my setups intraday, if I stick with my trading plan, my normal contract entry is only 5 contracts. I don't try to be a hero. I don't try to jump in and do 50 contracts. But with the volatility of the markets lately, sometimes the entry is only a couple of contracts. The key to true success in trading, we all know, is to properly mitigate risk. When you're trading futures, it's especially important to properly mitigate risk. So you start with a position size that allows you to take trades in the volatile environments that will not jeopardize your trading plan risk total. Just say you're going to risk $500 a trade. Well, normally you can do 5 contracts with that. Now you might only be doing 1 or 2 contracts. What I found out on the trading floor years ago, I know hedge funds use this technique, and hedge funds are very aggressive traders, mind you. But whatever amount of contracts they end up in a futures-driven trade, it's not what they start with. They'll start with a figure that they're acceptable, and there may be 100 contracts to a hedge fund trader. As a trend is continuing over the course of any given day, they keep adding to the position. They're adding to strength. If the market is starting to show a sign of reversal, retracement, whatever, they start, paring down their contract positions. What happens in a normal, strong day? It'll rally for a while, start to pull back. So at that point, they're exiting some contracts. Turns back up again, they're getting back in, they're doubling, etc. Another thing that I was going to point out earlier when you guys were talking about the trends of the markets and what people look for, there's this little period of time that's so important, in my opinion, from 4 o'clock to 4:15. Equity markets close their normal trading day at 4. Obviously, if there's earnings due out in a company, it's going to trade actively after 4. But if there's not an important earning in a particular stock or that industry group, that sector, there may not be a lot of trading after 4. But that 15-minute period is crucial to institutional trading firms and hedge funds. It's called the hedging session. It really shows their bias. When the institutions are bullish, they will be loading up on contracts big time. Now, I saw that last night, and I was not at all surprised late yesterday afternoon. It just said to me that They think it's a good thing that we're finally getting the midterms and get it out of the way and let the market go on about its merry path. But I do see a lot of days when the market might be strong. And I also see aggressive selling after 4 o'clock. The institutions are selling the heck out of index futures, S&P and NASDAQ, and they're not doing it randomly. Sure enough, overnight markets will weaken. Markets will weaken the next day. So I kind of like to gauge the market's strength at the end of the day by how aggressive the institutions are trading index futures after 4. Getting back to your initial question, it's no different from trading anything. You only take trades when you A, understand how to trade that trading product, B, you understand what your risk tolerance is. Never just jump into a trade if you don't understand the risks in the trade. Day trading specifically means you know your entry points and you know why you're getting in a trade and you know why you're going to get out of that trade. If I'm doing a breakout above resistance on an intraday trade, it's a piece of cake. My sell stop is going to be under whatever that low point was prior to when it broke out above resistance. You have, there's a limit to everything, but in theory, you have a bit of unlimited upside potential with very, very well-defined risk. So I learned on the trading floor that as long as the markets are trading continuously, we have control of our risk. You ask any floor trader, you ask any hedge fund trader, if they don't hedge risk after the close, what's the problem with that? The problem is that we don't really know where the market's going to open the next day. We don't know when an individual stock's going to open up the next day. So day trading, and I said earlier, guys, you can start doing this in the evenings when our friends overseas in the Asian Pacific Rim are beginning their trading days. They move markets, they just don't move them that aggressively. Mm-hmm. And if you do get in a position in the evening, Matt, we've talked about that, the famous go-to-bed trade. Works in currencies, works even better in futures. You don't even have to worry about what kind of profits you could have made 2 years ago on the election. When they were wrapping futures and there was a V-shaped chart, it came down. You had the buy stops in place. I was getting alerts on my phone about positions coming out. And then the market just went straight back up the other way. So one concession, all of us on trading floors, and I keep this in mind in my own trading business now, I used to use 5-minute candles to set up most of my day trades in futures. On the trading floor, you look at 5-minute candles to set up a directional stock trade. You confirm the direction on 15-minute candles. Do they look okay? Are they also bullish? Are they up against resistance? Blah, blah, blah. And we'd actually take our entries down to a 1-minute candle just to get a really low end risk on the trade. When the high frequency trading firms kicked in around 03, we started going down just 3-minute candles. Not for everybody, but I use a base of 3-minute candles on my futures entries, 15-minute candles on my Forex entries. I will always confirm with a longer chart. So in futures, I confirm with simply 15-minute candles, and currencies I confirm with hourly candles. The big difference, currencies, I want every currency trade to be a swing trade. It's not going to happen. Trends aren't always that smooth. But when I see a bullish entry on a currency pair or a bearish, we'll take the bullish scenario, on a 15-minute chart, maybe it's 10 a.m. The hourly candles look solid. If the daily and weekly candles look solid, well, that's going to be a swing trade. That's not going to be just a day trade. Futures, a lot of them are just day trades because the profit levels can be really high. So in a long-winded approach there, I'm just saying, get in a day trade where you totally understand your risk. There's no such thing as just entering and saying, well, I don't know when I'm going to get out of this trade. Nope, you're entering for a reason. Maybe it's not a breakout above resistance. Maybe it's a trend continuation. You showed it great on Wind, Matt. That was a perfect downward trend continuation trade on daily candles. Mm-hmm. If that's 3-minute, if that's 5-minute candles, I'm going to have multiple entry points. I'll establish my risk initially. At that point going forward, when it's trend continuation, I can just keep adding to winning position. And with the leverage you get in futures, you're very well rewarded when you can add to winning positions. And the strategy there is whatever entry point A was, entry point B. If you double your position, your average price is halfway in between. But one more time, if it's trending, your stop will be above where your average entry is. Your stop will be near where your second entry was. So you're adding, you're doubling your opportunities to the upside where you have no risk in the trade at that point. So when done properly, day trading is a blast. If done improperly, it's a good way to crash and burn your account. Nobody should day trade unless they understand, number one, trading principles, and number two, proper risk management.
Sure. One contract on the ES, by the way, love that. And thank you for the input there, Keith. One contract on the ES, Matt, is $50 a point, $12.50 a tick, 4 ticks every point. So even like the breakout here on the intraday at 2780 that ran to 2800, that 20-point move, one contract's $1,000 profit, so there is big potential in the futures market, but with gains, there's also losses. That's what leverage is all about. I love what you said there, Keith. You build on profitable trades, you build on positions. You start with a small position, you add to it as you build profit. Love the insight. Matt, you like futures as well. What's your reaction? What's your
Well, my disclaimer is very simple. If you're not a professional and don't understand every aspect of multiple time frame analysis and leverage and position sizing and risk rows, you shouldn't trade futures.
Yep, I agree.
I agree.
Yep. Yeah, but futures is probably one of the most popular day trading vehicles because of the leverage. The same thing can be said about the Forex market. I've really embraced futures recently over currency from a day trading perspective. And I want to reiterate what Keith said very quickly. I do prefer day trading futures when the market is closed.
Mm-hmm.
It can test your emotions when the market is open, especially in an environment where we've been in the last month and a half, 2 months, Tim, where volatility is increasing. Trading during the day is at whippet swings both ways. At night, you have a tendency to slow down a little bit. The trends are a little bit more consistent. You don't have nearly as much, random price movement, and you got some great type of time frames you could trade with the bank opens of like, the Asian markets opening up about what, Keith, 7-8 p.m. Eastern Standard Time.
Depending on time changes and the clocks
Yeah.
and all that. Generally, either 7 or 8 p.m. that Tokyo is going to open. Right now, it's about 8 p.m. in Hong Kong and Shanghai, 30 to 60 minutes later.
So you're talking about two major markets opening up that have an impact on the U.S. stock market, and the U.S. stock market will have a tendency to move in those time frames, but it won't move as volatile as the U.S. Market hours. So I enjoy day trading futures at night.
Yeah.
And if you do a trade at night, Matt, as you know, let's just say I do take a trade. Just pick 08, 805, 810 off of 3-minute candles. As long as the trend's okay, I'm not going to do much with it by 8:30 or so. I'm starting to let the 15-minute candles work in my favor. All I have to do is leave a stop at better than break even. I may not have a lot of money in the trade yet, but I'll just as soon carry that trade into the overnight time frames, because the second big area of trading, of course, comes in is the European and African money centers kick in 2, 3, 4 a.m. East Coast time. And boy, they move futures dramatically. You saw that last night with the after the midterm election results were coming out.
Right here. This is it right here. So this is kind of coming into the election right here, boys. You had that, positive momentum trend starting to develop. After, we kind of understood around the 9 o'clock my time, 11 o'clock Eastern time, you kind of settled down a little bit after the, kind of the election results came in. And then here's the European Open right there. Boom. Look at that price movement here. And so what Keith taught me many years ago, Keith, when you were teaching me the go to bed trade, it's you make that trade on the open. You initially have a stop loss underneath your 15-minute candles. As the trend is starting to go with you, you then adjust that stop loss to that break-even point right underneath that next support level. And then it just runs with you. If you get stopped out, you get stopped out at a slight loss, slight gain, break even. But you have the trend moving with you. You have those overnights moving with you. That's a prototypical go to bed trade right there. What we saw last night.
Absolutely.
Day after the election, markets rally. Obviously, a lot of action out there. And thanks for being a part of our halftime crew here. Matt, a lot we got going on here today. I think there's a Tackle 25 mastermind group later tonight. We've got a couple hours here left in the trading day. Obviously, can impact some of that. Tackle 25 is an important covered call list. And I've talked with Keith over the years about this, how important it is to have cash flow as well as your directional trading. We're talking about directional stuff here today, breakouts and day trading and futures. But for your IRA and for your long-term portfolios, the way that you build a lot of times is with things like covered calls, So talk a little bit about that Tackle 25 list.
Tackle 25 is our list we put forward every single year. The first week in January every year, we put out a new list, and we let that list kind of just go through the entire year. It's a list that we it's a fundamental list. It's a technical list. It's we go through all of our, let me just put it like this. I asked one of my students last night, and we were talking about fundamentals, and I asked Linda, I said, Linda, if it's on the 25, we've done our due diligence. right? To make sure that these are liquid, fundamentally strong companies, not too overvalued, those types of things. But we use it to generate cover calls. We use it to generate cash flow with naked puts. And, some traders use it to just, do credit spreads on, especially on those high dollar ones. But the primary purpose of the Tackle 25 is a covered call list designed for retirement accounts so that you can compound gains off cash flow to create wealth in the long term.
Yeah. And Keith, cover call is a big part of your IRA trading. I know that we've talked about that in the past, and it's something you usually work with your clients. And you guys were talking about how you need to be an expert and a professional to trade futures. Cover call, you got to learn, how to execute them. There's no doubt about it, but it's great for new traders as well, don't you think?
Absolutely, guys. I have a confession to make. I might have told you this in the past. When I first left the trading floor, because I made my living on the trading floor watching futures and realizing stocks would follow. Back in the days when things were manual, you had about a 10 or 15-minute head start when the futures rallied before the stocks did. Now, of course, they're almost simultaneous. When I left the floor, I'm like, yeah, I'm going to be trading my futures, making a lot of money, trading Forex, swing trading Forex, making a lot of money. And I'll hold my stocks, my core holdings. And then all of a sudden, it was probably a year or two after I was left the floor. It was after the crash of 2008 when the market started to really bounce. And I woke up. I'm like, why in the world aren't I doing the cover calls trade? I had core holdings. I bought things in IRAs. So everybody should do those. And this wasn't a case of me not understanding that. I was just, I have to admit, I guess I was a little bit cocky having been a floor trader, knowing that I was going to trade futures very well. But you have anything that you're holding for any length of time, why in the world wouldn't you be selling calls against it? The big thing there is just make sure you understand the risk of the individual stock and what moves that stock. Does that move with a certain sector? Does it move with a certain index, etc.? Once you've done that, that's what I was saying before, MasterCard and Visa, longer term, great trends. You guys have UNH. I mean, that's just a great longer term trend monthly candle. So yes, anything that we're going to hold longer time, I put my pride in my pocket and just say, I'm going to go after these little, 1 and 2 and 3% returns every month, in addition to what the stock might be doing anyway.
Yeah, so, I love what Keith just said, but Keith, day trading is that sexy. It's sexy to go day trade, right? And I'm gonna go get rich real quick, and then you get punched in the face really hard by Wall Street day trading it every now and then. You're like, oh, I really am going to go embrace 2% compounded cash flow every single month. There's a room in your portfolio for all of it, number one. Day trading is a great way to create earned income. Swing trading, a great way to create earned income. But cash flow systems through the cover call through an IRA are a great way to create wealth from a capital gains perspective long term. And anybody who is not doing that in a retirement account, compounding gains, writing calls against long-term holdings, learning how to protect those long-term holdings in bearish conditions, they are missing out on a wonderful opportunity, because I know that everybody 25, 30, and 35, they don't believe that 40, 45, 50, and 55, and 60 are coming. But at some point, who was a cocky 27-year-old trader, 40 came very quickly for me, Tim. And I wish to God I would have embraced things back then that I embrace today, like simple cash flow systems with 2% monthly growth, compounding those into the market to create long-term wealth. That is something that will fundamentally change the balance financially of everybody's life if you can keep that long-term mindset, that proper long-term mindset. It's not about every day going out and getting rich. It's about compounding gains long-term to create wealth. That's what trading and investing is about.
I agree 100%. And so if you are a trader who would love to learn the cover call, or if you are a cover call trader and just want to get an update on our watch list called the Tackle 25, come and join us tonight, 8:30 p.m. Eastern. I put the link for the Tackle 25. There's some actual nice videos and some training on how to do cover calls, our rules. They're all in that post over there, Matt. So looking forward to that tonight. Guys, great job. Keith, thanks for being here. Much appreciated.
Pleasure. Thanks, guys.
You're a rock star, as always. Great job, Matt. Great job, Cody. Good job on the prep. And we will see everybody out there. Halftime crew, we'll see you tomorrow.
Thanks, guys. It's been fun.